Good afternoon, everybody. My name is Miles Clark. I'm joined here by a good friend and colleague, Joseph. How you doing?
Good,
Doing
good.
well. Yeah, we are recording here on Wednesday, the 18th, the day before Juneteenth here. So we'll be off tomorrow. Markets are closed. I'll be relaxing at home. But we are going to go through our five charts for the week. It's been a pretty quiet week, but there has been a lot of stuff that has kind of happened underneath the hood. It doesn't feel like there's a lot of stuff going on, or maybe it's just more of the same stuff really going on.
hmm
But regardless, a couple different exciting things we're ready to talk to you all about. Starting off with just the performance for the last week. What we were talking about before, about a
Yeah,
percent off.
S&P was down about 1% over the past week. Nothing big has happened within the market.
Yeah.
Obviously, the Israel-Iran escalation stuff has really taken over the news over the last week. But in terms of market movement, everything's been pretty muted for the most part.
Yeah. A lot of this stuff, is just headlines and people are kind of waiting and seeing. A lot of this stuff can get drawn out towards the upside. Of course, it's going to have impacts on various parts, whether it just be broad market. Crude oil has seen, jumps, major swings either
hmm
direction. That won't be one of our featured charts, but might squeak its way in there one way or the other. Where do you want to start? Do you want to start off just with Dolly in general?
Yeah, so dollars are one of our asset class ranking systems. We did see commodities move up to the top spot. Um, International equities dropped to second, and then domestic equities dropped to third. Although, when we look at the signal counts for each of those groups, domestic equities has 241, international has 241, and then commodities has 243. So everything's really jumping up at the top. There's no clear leader, even though commodities is at the top spot. Um, it got to that top spot due to some signals gained from energy moving up.
Right.
But really within commodities, the main area of strength continues to be precious metals. Um, Even with some of the short-term strength in energy over the last week or so, long term, it's kind of been a longer term downtrend. Still a lot of resistance above that's got to take out before we say, like this thing's really starting to get going and forming a longer term trend.
Yeah, I want to go back to the Dolly rankings. So, as
Mhm.
Joseph just mentioned, dynamic asset level investing, short for Dolly. It helps us use relative strength to pinpoint what areas are strong, what areas are weak. We mentioned those top three asset groups, commodities in first, international equities, now domestic equities in third. But as you mentioned, they're very close within signals. So this is where it can typically pay to have a little bit of patience, whether you're either using a signal buffer to say, hey, these guys aren't far enough apart to really go and change broader asset allocation, or a lot of clients that will call in that will call in that are using the rankings will look at something on a monthly
Mhm.
basis, so they won't take intra-month rankings or changes or something like that just to give the asset class rankings a little bit more time to digest and figure out true leadership. So, what we're about is not about chasing or changing on a, completely pivoting on a dime. Essentially, we're waiting for confirmation. That change is part of that, but with, the rankings being so close, I guess what I'm trying to say is we could see some continued flip-flop. So just be cautious. And when you are making broader asset allocation choices, I would say maybe just take this as confirmation that there is a lot of different options available to you that are strong. International equities are strong, as we've touched on. Commodities, intra-asset, gold, precious metals, as we'll touch on in just a moment, pretty strong. Domestic equities, pretty strong. So I wouldn't necessarily say domestic equities is leaving the spotlight. It's more so of just, hey, there's a bunch of stuff that's doing pretty well right now. Is that fair?
Yeah, I think that's the exact right tone for what we're at right now. I mean, if you started in 2024 and you were just in domestic equities, you would probably be pretty happy relative if you just owned international equities at the start of 2024, for
Yep.
example. 2025 has been the year for international equities. A lot of that has come from pretty significant decline in the dollar, which we'll talk about a little bit. And then commodities, precious metals were really strong last year too, and that they've just continued to do really well this year also. Um, I think the big thing is here too is even though those top three groups are tied, we see a pretty big
Right.
dispersion between those top three groups and then the bottom three groups, where you got cash at 142, currencies at 121, and then fixed income at 103. So the spread between third and fourth is almost 100 signals,
Right.
whereas the top three are all within, two or three signals of one another. Um, so before you make any major changes, uh, I would probably wait and see until we get a clear leader here before you make any changes if
Yeah.
it's different than what you already currently have
Yeah.
in your allocation.
That's fair. And you talk about, I guess the next place we can go is going to be, well, choose your pick, but I guess we can go, I'll choose it for us. Precious metals, we talked about it last week a little bit with me and David talking about silver and gold.
Mhm.
Gold actually has an investable asset, an ETF most of you all will probably be familiar with or have allocation to GLD within your portfolio for gold exposure. Gold, GLD, pretty interesting technical picture. We talked about a little bit of consolidation, while something like silver or other areas of precious metals have done pretty well throughout June so far. Gold consolidating a little bit more, but it is, if you take a look at that GLD chart, quite an interesting kind of a bullish development with what we would call a shakeout pattern, where we posted a sell signal, kind of shake out the weak holders, then get a reversal back up, and are now attacking some all-time highs. So that's a quite an interesting kind of default picture here. And if we do break that kind of break out to the upside there, that would be a further or furthering of that idea that precious metals leadership is well underway, specifically within gold, and it's just nice to see silver participating as well.
Yeah, I mean, silver has broken out to a new multi-year high. I think we were looking at it earlier. What's the highest
Yeah,
level since
2011.
2011?
Yeah,
Yeah, so over a decade. Um, But yeah, gold formed that double top in May, gave a sell signal later that month, and then has since kind of reversed back up and back up to resistance there at 315 to form a triple top. So a breakout to 320 on GLD will complete that shakeout pattern, moving to a buy signal. Um, but again, that's been one of the most consistent areas of the market over the last, year and a half now.
right. And it's boring to talk about. I mean, I feel like every single time we're like, oh, well, what do we talk about or what do we write about in the report? And it's like, what's working from commodities? Well, it's been, at least before June, before kind of all this stuff with the Middle East has been going on. It's been like energy, not so good, precious metals, gold, pretty good. And it's just kind of like more of the same. And that's going to be a constructive market environment for trend followers, right?
Mhm.
When the thing that's doing well continues to do well, that's a good thing.
Yeah.
So yeah,
And that's kind of what we've seen with like some other asset classes too, like the dollar,
yeah,
that has historically trended pretty well, although the last few years it's been a little bit more choppy. But it's trading on four consecutive sell signals, hit a new multi-year low. Obviously, a pretty big tailwind for international equities, um, which have done extremely well this year. Whether you're looking at like EFA or even emerging markets have really started to break out as well. So the dollar kind of continues to fall, um, has, really just consistently headed lower and lower. Some brief periods of consolidation, but it doesn't look like this trend's turning around anytime soon.
and I'm curious your opinion or thoughts on the catalyst for that. I mean, from a technical perspective, we say that the dollar tends to trend. Of course, there's a lot more in play for, currencies, commodities, whatever it is, than just pure technicals, right? But what is that like? What's kind of the fundamental catalyst for a weakening dollar? Is it rates? Is it a rate environment? Is what is it?
Well, it's kind of hard to say that it's rates, right? Because the traditional thinking is like higher interest rates lead to more attractive debt, which leads to more attractive investment from international
Right,
investors, where, you know, interest rates in the US have kind of remained the same. The Fed hasn't cut rates at all this year. It
right.
doesn't look like they're going to cut until September, whereas the ECB has cut rates pretty significantly and pretty consistently over the last 12 months. Um, you've seen a lot of flows, if you look at just like fund flows and things like that, into international equities. So I think a lot of it is just international investors pulling some of their money out. Obviously, we had Germany had a pretty big spending package that passed a few months ago. Um, so I think we're just in this environment where there's just a greater appetite for foreign equities at this point, which
Right.
is what's driving that weakness in the dollar.
That's a good point. And then it kind of becomes more of like a tail wagging the dog because, you get, those flows into international equities, greater appetite for the international equities. then that flows out of the US dollar, which then is a weaker US dollar, which is then better for international equity. So it's kind of like a big circle. But anyway,
Yeah.
anyways.
Yeah, for sure. For sure. We'll see how long it keeps going. When you look at the dollar, I think there's going to be some support in the low 90s, and we're right around 98 right now. So it could fall further, but I don't expect it to just completely deteriorate,
And I'm
you
not
know.
looking at the chart. What is that? Where would that support come in? Like what year is that?
Um, that goes all the way back to 2022,
Okay.
right around 95, 95.50, and then there's some more support in the low 90s.
Okay.
Yeah.
Cool. So we'll have to see. I mean, international equities, they've been a spot. And, not that it's one of our featured charts, but it did come across my desk this morning while I was doing the morning video. EFA reversing back down, seeing a little bit more of normalization. So
Mhm.
developed markets, international equities in general have cooled a little bit. I think this is actually a pretty decent opportunity to go and pick up exposure for those areas that are normalizing a little bit because a lot of those technical pictures, we've been essentially overbought or it just never feels like the right time to buy. And as we get these pullbacks here, again, constructive pullbacks, I think we could both agree,
Mhm.
it could be a decent opportunity to go out and pick and choose names that you've been wanting to buy but haven't been able to.
Yeah, and developed markets are probably the place where you're going to want to stay, with just like
Yeah,
EFA. Also, the relative strength and momentum market in developed equities has remained really strong. It's kind
right.
of, we look at like the RS spread for just developed equities. It's kind of just continued to trend higher and higher, where domestically it's been a little bit more choppy. And then on the emerging market side, it's been super choppy. A lot of it has to do with China being a major laggard, and then they do some crazy stimulus package and we rally
Right.
20%. And then it's like, oh, like they still got a lot of problems, so that we fall another 20%.
China with problems, right?
Yeah,
Yeah.
yeah. Um, so yeah, I think developed markets are going to be the primary area where you want some international allocation, or that's where most of your international allocation should be at this point in time, at
Yeah.
least.
And speaking of international, of course, the big news on the docket over the last week has been continued unrest or emerging unrest, in the Middle East, with, breakouts of, attacks and things like that. That has led, of course, to a increased interest, possibly. I mean, there's certainly been a couple of calls that have come into the Dorsey office over the last few weeks in defense names.
Mhm.
When people think that there's continued unrest or things like that, further military spending, military involvement, whatever that is, good or bad, whatever the reason, you are attracted to military names.
Mhm.
Um, so, we can throw up the next chart. It's going to be PPA, which is going to be an aerospace and defense representative here. Pretty constructive year so far, almost 19%
Mhm.
in 2020 in its 2025 campaign. It's a bit extended here as we've kind of rocketed, no pun intended, towards the top of the trading band here. Really only gripe with this chart is that we don't have support until around 25% lower than what we would currently see. So you'd have to see, take a big haircut to get down to that traditional support. But if we did want to play, some old resistance, middle of the trading band, I think 124
Mhm.
is that level here. That's a pretty significant point of old resistance in that 50-day moving average. We could see a logical pullback too.
Yeah, and we'll see what happens in the Middle East. I mean, it's really, who knows? Like
Yeah,
the news headlines seem to change. Like there was a headline this morning that Iran was sending out delegations for peace talks, and then that got refuted by somebody else. So it's like you don't really know exactly what's going on. Um, Obviously, that risk has been priced into the market somewhat. We've seen crude do pretty well, and then we've seen PPA, or defense names do really well also. But I do agree, like that 122 to 126 area would kind of be the buy level, I think, for PPA. As long as it kind of holds above that, it's a good area to lean on moving forward.
yeah, and to your point about headlines, right? I mean, we've talked about this in podcasts before, but there is going to be headlines. I mean, people buy what they know, and typically that's going to be like buying Wrangler jeans because they wear those to work or whatever. But as people are watching the news, they see all this stuff, they're going to call in, they're going to ask how they're positioned, in case this kind of continues to deteriorate or whatever it is. So having a list of names that's technically actionable, having action points for you, whether it become to a broad fund or an individual name underneath the hood, could could pay some dividends as you enter those mid-year reviews with clients. And, this type of stuff is at the front of their mind and they
Mhm.
ask questions. So having that, not, but at the same time, not letting those headlines dictate your overall allocation, right? We do still want to let price do the talking here, not what happened on last night's news. So,
Yeah, exactly. Um, and with talking about headlines, it seems like people completely forgot there was a Fed meeting
yeah, yeah,
today.
yeah.
Pretty big Fed meeting too. There was dot plot projections and things like that. Um, but the Middle East stuff is going to play a pretty big role because of its. I think the biggest thing is going to be the impact on oil prices when it comes to just financial markets. Because if we see oil markets kind of stay elevated or continue to increase, you're going to see that baked into CPI, inflation readings, and things like that. Then we say, okay, we're going to actually have to hold rates even higher from now on and whatnot. And then on the other hand, you got economic data coming in, like the housing data this morning was really weak. Um, so there's a lot of give and take going on right now and a lot of uncertainty, especially when it comes to, I think, just what the interest rate policy is going to be moving forward. I saw somewhere where right after the Fed meeting, the two most likely outcomes are that we cut 50 basis points or we don't cut at all through the end of the year. It's not that we get one cut. It's
Right.
either we
It's
get
just
no
like
cuts
nothing
or two
or
cuts. Um, So we'll see how it plays out. I do think if we get some more clarity on the Middle East situation and some simmer down of the tensions, I do think oil probably falls back into the upper 60s range. Um, and it's not that big of an issue for CPI. And we kind of continue on that trend where we get a couple rate cuts by the end of the year.
yeah, no, I couldn't have said it better myself, so I won't ramble or anything like that. Speaking of, and kind of wrapping up today's podcast with our last chart of the week here, talking about consistent leadership throughout 2023, 2024, first portion of 2025, and then off the rally or off the 2025 lows, growth has been pretty strong. There's been some hiccups along the road and everything like that. You think back to 2022, I mean, geez. 3 years ago at this point.
Yeah.
We're getting old. Um, but you look at the consistent leadership. VUG, throwing up that chart on screen now, has been a stalwart of strength over the last few years and is now coming up to a pretty significant point on its default chart.
Yeah. Forming a spread sextuple top there.
Can't say that every day,
Yeah,
right?
at 425. So a pretty big area of resistance up here. We'll see, there's really no true support till you get down to 340. So 425 to 340 is a pretty big haircut. But we are back in this range that we were in at the end of 2024 and early 2025 between 405 to 425. I wouldn't be surprised on a pullback if we kind of saw the bottom end of that range, so 405 to 410, and that could act as support moving forward. But we'll definitely see how this shakes out. We do have OPEX this Friday, third Friday, and that's kind of strangely marks some kind of big turning points in the market this year. Um, so we'll we'll continue to monitor this. Obviously, large cap growth has been the premier place in the market over the last few years, despite that, kind of hiccup earlier this year. Uh, it's let off the bottom significantly. I mean, values lagged a lot.
Right.
Um, if this can break out to new all-time highs, that'd be a really good sign for the market, I
Now
think.
I'm interested in maybe to test how well you've been listening to the podcasts that we've been recording. A few weeks ago, Ian and I were chatting and talking about what would be better or more constructive for markets. Is it a break to new all-time highs, or is it really just camping out around current levels, just a few percentage points off all-time highs, and then giving us kind of a base camp to work off of? So curious on your thoughts on that. What is better? Are we trying to get up there and establish new all-time highs sooner rather than later, or do we really just kind of want to, give ourselves ground to work on in the back half of the year?
Um, I mean, pullbacks can be healthy, right? We've seen a little bit like VUG was at 425. It's now down to 420, so it's dropped 5 points, which, isn't a ton. It's like a little over 1%. Um, maybe a pullback. I think you just really want to see volatility remain kind of in at the most the low 20s. The way the markets function nowadays, I think. if you just break out to new all-time highs, I think that'd be a better sign
That's a better sign.
than if it fails to get to a new all-time high. Um, so that's my take on it. You know, people usually want kind of support, but if you're looking at this, let's just pretend April never happened with the tariff stuff and we just washed that away. We've essentially just gone nowhere over the last 3 months anyway. While we may be a little bit overbought on a you know weekly basis,
Right.
it's not like we're overextended from a 6 month perspective or anything like
Yeah.
that. So a little bit of a different situation. Now, if we were at all-time highs trading on a stem and there was no support, except for like 10% away, then I would say, yeah, you probably do want to pull back before you continue higher. But I think this situation is just a little bit different.
Cool. Well, I appreciate the insights as always. I'm sure the listeners do as well. And you got any last thoughts, or we can wrap up here?
No, I don't think so. I think the biggest thing is like when Dolly, we have those three asset classes at the top. I would be patient here and wait for more clear leadership to develop before I make any changes from my current allocation. But that's pretty much it.
Very well said. I would tend to agree. As always, appreciate you all's time here. If you've got any questions or anything like that, feel free to shoot us an email. Reach out to us if you ever want to see anything or have any suggestions for the podcast or anything along those lines. We do this for you to help you make the best use of your day, whatever it is. So give us a holler or anything like that. Otherwise, appreciate it. Everyone enjoy your week, and we'll be back again next week to touch on any developments. Thanks.